Welcome back to Finance Shift. This is the second video on the stock market series. In this video, we will see how to start investing. If you are new to this channel, please do subscribe to the channel. And if you haven't watched the previous video, go ahead and watch it. That is the video on what is stock market. You need to understand the basics of stock market. Then only you should start investing in the stock market. So I please request you to go ahead and watch that video and then come back to this video. And as always, if you have any questions, please ask them below in the comment section. And if you want to have a detailed discussion, right, you can go ahead and join the Discord groups that is given in the description below. So without wasting much time, let's get started with the video. So before learning how to start investing, right, first we have to understand why one should invest. You might have different reason to invest, right? Like you want to build wealth, or you want to retire early, or you want to buy a beautiful house, or you want to save for kids education. All these reasons are secondary. The primary reason to invest is to beat inflation. So, what is inflation? Let us say in 2016, right, you could buy 4 apples for 100 rupees. And today in 2026, you'll be able to buy only 2 apples for that same 100 rupees. Why that is the case? Because the money has lost its purchasing power. We can illustrate this in a different way. Let us say in 2016, right, to purchase 4 apples, you needed 100 rupees. And to purchase the same apples today in 2026, you will need 200 rupees. That means the cost has doubled in 10 years. So this constant rise in price, which reduces the purchasing power of the money, is called as inflation. So if you go to my website, which is financedev.com, right, you can go to the blog section and click on this what is inflation and how to beat it article. You can read about inflation, what is inflation and what causes inflation and what are all the effects of inflation. I'll give you a link in the description below, or you can scan this QR code and go directly to the article. Now based on different places where you can invest, right, they are categorized into different asset class. I hope you are already investing in FD, so you can invest in FD, bonds or debentures. All these are collectively known as debt. I'll do a different video on explaining different ways of debt investments and returns from debt, right? They are usually between 6 to 7%, which is where India's inflation is at. So debt instruments are designed to meet inflation, not beat it. Next is real estate. Real estate can be tricky. There are multiple constraints like ticket size. You'll have to have good money to invest in real estate. You cannot start with like 10,000 or so. And then there is liquidity issue, and you have to be very choosy. You'll have to invest in a place where the appreciation will be really good, and it is possible that, let us say, after 10 years also this value of the property will remain the same. And next is commodities like investing in gold or silver. As you may be aware, right, the gold and silver prices have surged a lot in the recent past. It is not necessary that it will happen in the near future. So gold and silver are very cyclical. There could be times where these move sideways for decades and then break out and move up like crazy for 2 3 years. Next is equity market or stock market, where you can invest via stocks or mutual funds. And Nifty in the last 25 to 30 years, right, has given an average aggregated annualized return of around 13%, which is higher than the inflation of 6 to 7%. Now let's see how money compounds in the long run. For that, I'll go to my website and go to compound interest calculator. So I've given the principal amount as 10,000 and expected return rate as 7%. That is what you can expect in an FD, and that is the inflation rate. And I'll say period as 10 years. When you have a 7% interest, right, your money doubles in 10 years. Remember, the inflation is also 7%, so your money doesn't really appreciate in value. Now let us say you invest in Nifty Rand, you get 12% per annum, and you invest for 10 years. And at the end of 10 years, right, your invested value has actually tripled. Of course, the purchasing power has halved. That means today's 10,000 invested in Nifty for 10 years, if Nifty returns 12% per annum, then it will be worth half of this, that is 15,000. That is, the purchasing power of your money has increased by 50% in 10 years. So this is the reason you have to invest in stock market. Again, this 12 or 13% is historical returns. It is not guaranteed that you will get 13% going forward. Now let us see different ways in which you can invest in stock market. As we have seen earlier, right, there are two ways in which you can invest. One is buying a share or buying a basket of shares. Buying a share means you go to your broker and say, I want to buy these many shares of HDFC Bank or Reliance or whichever company you want to buy and place the order there. The problem with buying a share, right? You'll have to do the research and you don't know whether the stock is going to do well or not. And if you have limited money, right, you will not be able to invest in multiple companies. For that, there is something called basket of shares. How do you invest in basket of shares? Via the mutual fund route. Mutual fund is an instrument which collects money from multiple people and pulls it together and invests in a group of stocks. There are different types of mutual funds. That one is active funds. Active funds is nothing but there will be fund managers who will have a research team. They will research the stocks and come up with ideas and they will decide which stock to buy, which stock to sell, and it will be actively managed. I'll do a separate video on mutual fund masterclass, so do subscribe to the channel and wait for that video. Next category is index funds. Index fund is nothing but I told earlier, right? You cannot directly purchase Nifty, but you can invest in instruments that track Nifty. Index fund are one of that type. There are index funds available for Nifty 50 or Nifty small cap index and all major indices. You can purchase the active mutual funds directly from AMC's website and it will be stored in folio form. Next, if you purchase the mutual fund from the broker, right, it will go to platform like BSC Star and it will be stored in dematerialized form in your demat account. You can purchase index funds in folio form as well, also in dematerialized form. Also, there is something called ETF or exchange traded funds. These index funds are traded in the exchange, so you can directly go to your broker and purchase the ETF whenever the market is trading. When you purchase a mutual fund, right, the price is decided after the market hours by the AMC. But when you purchase ETF, the price is decided on the exchange then and there. So that is one of the difference between buying a mutual fund and buying an ETF. I'll explain in detail about other differences when I do the mutual fund masterclass series. And next, let us see few of the mutual fund terminologies. NAV. NAV is nothing but how stocks have price, right? Mutual funds have NAV. Technically, NAV and price are not same, but for sake of this video, you can consider NAV as price. Then you have expense ratio. Expense ratio is nothing but the price the fund house or the fund manager charges for managing your money. The expense ratio is already priced in the NAV, so you'll not have to pay additional fee. It is already paid and then they calculate the NAV. And then we have NFO, which is new fund offering. It is IPO for mutual funds. Now that we have seen different ways of investing, now let us see different styles of investing. First is lump sum. That is, you buy shares of a company and you hold it for the long term. Next is SIP or systematic investment plan. SIP is nothing but a style of investing in a periodic manner. Let us say you want to invest 1000 rupees every month in a stock or a mutual fund. The period can be anything, every month, every week, every day, or once in a year, once in a quarter, whatever is preferable for you. The most popular period is investing every month. So this process of investing every month or every specific period of time is called as SIP. You can automate this process in most of the brokers. In the later part of the video, we will be seeing how to automate the SIP. Now let us see why lump sum investments may not be a great idea. Let us go back in time. Let us go to 13 January 2020. The index or Nifty was trading at 12,300. Now let us say you have bought an ETF or a mutual fund which tracks Nifty and you invested 10,000 rupees. Fast forward, on March 30, 2020, the index has fallen to 8,000. That is a fall of 35%. That means if had you invested 1000 rupees, it would have become 6,500 rupees. So this is the problem with lump sum. You wouldn't know when the market will crash and let us say by bad luck you invested at the top and you will have to see this dip in your portfolio. Now let us see why you should invest in SIP. One is you get cash flow every month. You might be running a business or if you're a salary person, every month you will get a cash flow. So you can invest a part of that money in the market in a systematic fashion. Next is discipline. When you invest in a monthly fashion, it brings in a discipline to do that investment, then only spend the remaining money. Finally, the most important thing is the rupee cost averaging or dollar cost averaging. As we have seen here, right? Had you invested in lump sum here, we would have seen a drawdown of 35%. Instead of that, had we done an SIP, that means had we bought every month, then what would have happened, right? Every dip we would have bought, every time the market went down, we would have bought at 8,000 rupees also, and we would have got more quantities. And when the market recovered, right, we would have made profit even though market did not cross the all-time high, because we purchased here at the dips or the bottom, right? Whenever market reached somewhere here, right, we would be already sitting in profit. But the person who invested at the peak, right, had to wait till the market has completely recovered, then only they would have made profit. So that is the reason you have to invest in SIP, not in lump sum. Of course, you can invest in lump sum whenever you see the market has crashed so much and you have some free cash, right? You can always invest in lump sums. But for the long run, for the wealth creation, you have to invest in SIP. And if you want to see how a fund has performed in the past, right, you can come here and check. Let us say HDFC Nifty 50 Index Fund. So this is the historical chart of the fund. It was launched on Jan 1st, 2013. So this is how the fund has performed. This is HDFC Nifty 50 Index Fund that tracks Nifty 50. And if you see the discrete returns, right, it has given negative returns in 2015, and in the current year it has given negative returns. And if you see the SIP return, and let us say I invest for 10 years, the annualized return is 13.56 percentage. My total investment would be 1.2 lakhs. That is 1000 rupees invested every month for the last 10 years. The current value would have been 2.43 lakhs. That is a return of 1.23 lakhs. Now, if you see here, right, if you go to March 20, right, the total investment is 49,000 and the return is 39,000. That is doing SIP for 4 years, your return would be in negative. So you should be ready to see loss in portfolio even after investing for, let's say, 4 years. And if I increase this to 13 years, right, and again on March 2020, the total value had come down to your invested value. That is, investing for 7 continuous years, there was zero returns. So always invest with time horizon like 10, 20, or 30 years. Don't come to stock market if your investment horizon is like 2, 3 years. Don't think that I'll invest for 2, 3 years, I'll double my money and go. That is not going to happen. So you should have patience. You will see your portfolio dipping. Let us say here it was 1.2 lakh and going down to 85,000. That is in the span of just a month. And had you booked the loss and went, right, you would have made the loss and you would have felt, oh, stock market is some gambling. It is not a place where you make money. But had you stayed invested, right, now see a total investment value of 1.5 lakhs that has gone up to 3.82 lakhs. So that is the beauty of stock market. Money can be made and money can be lost also. Whoever is patient enough will make money in the long run. And my framework of investing for beginners would be: put 90 percentage of your investable capital into mutual funds and remaining 10 percentage into stocks. That also only if you're interested in buying stocks. If you're not interested in buying stocks, then you can put all 100 percentage into mutual funds. So this gives you cushion. Even if you lose this 10 percentage gambling in direct stocks, then you have this 90 percentage which is actively managed or even in passive index funds. Then if you are able to beat the index and professional fund managers, then you can consider increasing your stock allocation. Remember, when you take high risk, there are two possibilities: you will get high return or low return. But when you take low risk, you will not get high return. If someone is coming to you and telling there is a scheme where with low risk you can get high returns, then run away. They are scamming you. So I've been investing since 2017, that is 9 years now. I can tell you with guarantee that there is no scheme where you have low risk and high return. With low risk, you are going to get low returns. So in stock market, risk is guaranteed, return is not. Now, as they say, don't put all your eggs into one basket. You should have your asset allocation. You should sit with your financial planner and plan your finances. And this is how my asset allocation looks like. I might change it in the future. I have 60 percentage in equity, 35 in debt, and 5 in gold. And final thing before seeing how to start investing, remember to have your emergency fund sorted. Have at least 6 months expense in a liquid mutual fund or FD. Get a term insurance that will cover your financial dependence if something happens to you, and have a separate health insurance which is not your company's one. And now let us get into the most interesting part of the video: how to buy and sell a share. As I've told before, you have to have a demat account with the broker. I'm not going to explain how to open a demat account with the broker. There are multiple videos in YouTube, or you can just Google open demat account with zero the fires or grow, you'll get a link. It's simple steps. You have to fill in your details and give your bank details and do the KYC. After, let's say, 1 or 2 working days, your account will be open. So I assume you already have your account open. And now let us go to my demat account. So I opened Kite here, which is Zerodha's web application for buying shares. So now I'll show how to buy in the mobile app as well. I can search for, let us say, Reliance, and I've added to my watch list. I can click on BP means buy. I can say 10 shares. Here you can give long term, you are an investor. Then you can give either limit or market price. I'll just give market price for the demonstration. It will show you the charges as well. Of course, buying shares is not free. You'll have to pay a lot of folks here. I'll do a separate video on the charges that will be incurred during purchase of stock. So I'll click on buy. Market is closed now. It is Saturday. I get this error, order maintenance. Similarly, for selling a stock, you can go to holdings. You can select any of your holding and click on exit. Here you can exit all the quantity or partially also. Let's say I want to sell only 2 quantity. I can select that and I'll give market and I can click on sell. So that is how simple you can buy and sell a share. Now let us go ahead and see how you can buy a mutual fund. Zerodha has a platform called Coin for buying mutual funds. So I'll open that. You can explore different types of mutual funds. So I'll just search for Nifty 50 from HDFC. Always remember to choose growth fund, not the ICDW, which is dividend funds. So this will show the performance. You can either buy or do SIP. So first let us buy. There are different ways you can pay, either use UPI and net banking or NEFT or RTGS. So I'll do UPI. You can give the investment amount, I'll say 1000, and you can click the buy now and it will give you a summary. You can click on confirm and it will ask you to pay. Now it will go to payment screen. You can click on continue and you can open your UPI app and pay for it. Once the order is placed, it will come here. It is processing. So next market open is on Monday. If you have completed the payment, the order will get processed on Monday. Now let us see how we can start an SIP. Again, I'll go to the detail page of this HDFC Nifty 50 index fund. I'll click on SIP. This will give an option to AMC SIP. AMC SIP is not preferred because you cannot pause, resume, or step up functions are not available for AMC SIP. So I'll unselect that. You can give the mandate. You will not have any mandate. You can create a mandate. It will give you an option to create a mandate here. I already have an auto pay mandate. I'll select that. Then I'll say initial investment of 100 rupees and installment amount of 1000 rupees. That is 100 rupees will be detected now and 1000 rupees will be detected whenever I choose. Like, let us say I choose monthly and date as first. Always have the date in the initial week of the month so that the SIPs go in before you start your expenses. Then you can choose automatic step up if wanted. That means after a year, right, you can increment your investment by a certain percentage. Let's say 10 percentage. Today you're going 1000 rupees and next year it will increase by 100 rupees. That will be 1100 rupees. I'll uncheck this for now. It is recommended to have this step up SIP so that whatever you're inputting into the market also beats the inflation. Now you can click on create SIP and can give a confirmation. The SIP creation is successful. I can go to mutual funds SIP tab and see my all active SIPs. As you can see, right, HDFC Nifty 50 index fund is created. I'll just cancel it. I don't want this. So this is how you can delete or you can pause also. Let us say you don't want to do SIP for few months. You can go ahead and pause it or you can modify it. If you want to increase, you can do that. I'll just go ahead and delete this. Your order 100 rupees order initial investment would come here. You can go ahead and pay for this. So that is how you can do SIP in a mutual fund. Now let us go ahead and see how we can do the same thing in mobile application. I opened Kite in my mobile. I can go to the watch list and search for, let us say, Reliance, and I'll click on that and click on buy. Here I can give the quantity and I'll keep it as market order and I can just swipe and the order will be scheduled. So you can go to click on orders and see open orders. Since the market is closed, it has given us AMO order. Otherwise, it will get executed in the exchange. I can modify it or I'll just cancel this order. Similarly, I have BPCL in my portfolio and let's say I want to exit. I want to exit whole quantity. I can give the limit order also. Let us say I want to exit whenever the price reaches 369 and I can click on swipe to sell. Again, the order will be scheduled and will be sent to exchange whenever the pre-market opens at 9 a.m. on Monday. I'll cancel this as well. Now you can go to coin. You can buy mutual fund from there. I just logged in. I clicked on discovery and I can search for, let us say, Kotak Nifty Next 50 Index Fund. I can click on buy. The interface is very similar to that of web. It is just responsive to mobile, and click on buy, and you can change the investment amount. And if you want to put a conditional order, that is very similar to the limit order in stock purchase. You can choose the payment option and click on buy. You can choose to pay now or pay later. I'll not be doing the payment right now. Similarly, you can do the SIP, very same interface. Select the initial investment, installment amount. If you want to do a step up, do that and just create a SIP. Again, it will ask for payment. You can pay now or pay later. I'll just go to orders and cancel my SIPs. So that is how you can start investing in stock market. Hope you all like this video. If you have liked, please consider subscribing to the channel, and do let me know in the comments below what kind of videos you expect from this channel in the future, and I will see you in the next one.